Concerns about higher inflation weighed on returns last year. As inflation fears recede a bit and growth fears rise, are high-quality bonds the answer? With this uncertainty in the market, what can we do to deliver good returns over the rest of this year? We're going to be talking about that right now here on UBS Trending. Hi, everybody, and welcome to another episode of UBS Trending. I'm Anthony Pastore. I'm here with my friend and colleague, Leslie Falconio from the Chief Investment Office. Leslie, always good to have you here.
Thank you.
We don't get you here enough because there's always something going on in your world that we need to talk about. And today we're talking about bonds, particularly this new message and focus from CIO on high quality bonds. And the idea here is to buy them because especially right now with inflation starting to maybe recede a little bit, there seems to be a rationale for that. So why don't you fill us in a little bit about that particular message and focus?
Yeah, absolutely. I mean, we've had a bias towards this, what we call these higher quality bonds or up in quality type of bonds in fixed income. Because when you think about it, even when we entered into 2023, the outlook was at some point the Fed would pause. We're getting near to the end of the credit cycle, and more than likely growth would slow by the second half. Now, we've seen a little bit of more strength than we anticipated, particularly in the equity market. But when we think about how we want to position for high quality, is that we like things like investment-grade corporates, agency mortgage-backed securities, sustainable, and partly in the municipal market as well. So really the core is the anticipation of seeing some slowing growth in the second half of the year, have that income, right, but still have the credit quality where you're cushioned, just in case there is a stronger downturn in the economy than what we're expecting.
Right, which makes sense because there is a lot of uncertainty still out there, especially when it comes to monetary policy. We talk about the Fed quite a lot on this particular show, and we've done that as well. But before we get into that, and I know this is bonds relative to equities, which we're talking about, just to kind of clarify for the audience. But the question about recession is still out there. I think a lot of investors are concerned that we're going to dip into one. Does this rationale still hold if you see a recession on the horizon?
It does. And, you have to think about this. The question always shouldn't be yes or no when it comes to recession. It should be depth and duration.
But it's not black and white.
Right. Or how long will it last? Or how deep will it be? Mm-hmm. And, one of the biggest reasons why the strategy also works as well during a recessionary time period is that, you're not into that embedded credit where you're not offered a lot of what we call risk premium, being compensated for that credit. And if, in fact, the recession should come earlier or deeper than what we're anticipating, which, by the way, we don't think that's going to happen, then it's better to have these higher quality bonds because you have better protection in terms of balance sheet, agency MBS or AAA. Plus, when you think about it, more than likely Treasury yields will come down, which is also a benefit for higher quality. What
about emerging market sovereign debt? I know there's a call for that. Maybe it's slightly on the riskier side is the question?
It's volatile. It's definitely more volatile.
It's a good word to
there's
describe
no
it.
question. I mean, diversification is always the key, but as we know, we're in a situation now where they're much further ahead in terms of certain parts of EM and with their hiking. We also believe that we have the China regrowth story coming. We are looking, given the fact that we're at the end or near the end of the hiking cycle, then more than likely the dollar will depreciate. Mm-hmm. And we are looking for things like oil to come up, and hopefully, the volatility that we've seen for U.S. interest rates starts to sort of subside a little bit,
right,
which is all good attributes for EM performance as well. So it's always a good part to have in a diversifier, but there's no question they're volatile.
Right, that makes a lot of sense, and thanks for clarifying that, Leslie, because, obviously, coming back to the U.S. side, we always look at the benchmark 10-year Treasury. It's had an interesting run, although rates lately have been fairly steady for a couple of weeks since we saw the dip, the dip in rates after the banks kind of had a little bit of a tumble there. So with growth prospects, do you see growth ahead? Are we maybe dipping a little bit lower as far as that's concerned? Where do you see when you look at things like treasuries and the yield curve? What is it telling you?
This is such a difficult question because the market and the Fed are saying two completely different things, right? And this isn't the first time we've seen this, right? We have the market, which is saying, okay, Fed, you're going to ease in the second half of the year by about 60 basis points, which is about 40 basis points actually higher, if you will, than what we saw last week. So they were expecting 100 basis points of easing. Now they're expecting 60. And then we have, Powell and the rest of his constituents saying that we're going to have this higher for longer. We're not necessarily done hiking. So you have this divergence. So I think it's going to be really interesting. And the path will be twofold. Either you have a higher terminal rate, meaning that they go to that rhetoric when he was speaking with Congress, 5.25%, 6% for a shorter period of time, or you have a lower terminal rate where they go one more time, say, at around 5, 5.25% for a longer period of time. I happen to think the latter. I mean, I'm more in the camp that they probably go one more time for the information that we have right now.
25 basis points
25,
possibly?
yep. And then again, with the information we have right now, we have Friday employment. We still have a lot out there, as we know, they're data dependent.
That's right.
But if they go one more time, I think it's going to be a low, that 5.25% terminal, but just for a longer period of time. So I disagree with the magnitude of the easing that the market is pricing in today.
That's interesting. And look, the word pivot, it's overused and overasked. And I'm not just talking about the episode of Friends when Ross is trying to get the couch up the stairs. When that word pivot was used 100 times, we're talking about the markets and the Fed pivot. So that means, will the Fed actually start to take rates down? But you don't think that's going to, well, here's the question. I don't want to put words in your mouth. Do you think it could happen this year?
I think there's a potential.
And as you said, it's all up in the air.
We don't know. I mean, we talk about tightening lending standards. The tightening lending standards are tighter now since we've had this period of instability with the financial industry.
Right.
So, but we don't know the true magnitude of that. There is the possibility that they ease 25 at the end of the year. But here's the key when it comes to the markets. The fixed income markets are forward-looking. Okay, so all the fixed income markets need to see is for the Fed to pause. They don't have to ease before they price in that easing. Mm-hmm. So when you think about how we're positioned for that lower 10-year yield. But it's also important to note that one of the benefits of having this higher quality today is that you're not giving up a lot of carry or a lot of yield, in order to go into higher quality. So if we're at a 3.40 10-year yield right now, and we think we go to 3.25 at the end of the year, that's not a huge amount of price appreciation, right? We're going from 3.40 to 3.25. That's not, but you still get that income in higher quality that will protect you through volatile markets, which will most likely be the case.
Right, and we've talked about the inverted yield curve, and it's been inverted many times for the last year, almost year and a half. A year, okay. Yeah. And so obviously when you have an inverted yield curve, by definition, if you're taking a 101 finance or economics class, it means recession is on the horizon. But you're saying that that's not necessarily the case here.
I think there's a lag, and we're seeing that lag now, right? To the point, we've had a year of 2s10s being inverted.
Sure.
Okay. There's no
and it's not like they've stayed inverted the whole time. They've kind of flip-flopped around a few times in that year.
They've pretty much stayed negative for the year. The inversion has pretty much been a solid kind of trend. They're less inverted today than they were in the beginning, during the time of the heightened I want to say in the beginning of the year, and particularly during the time he was speaking with Congress. Then they really became inverted.
Yeah, right.
And it did that because the market said you're going to keep hiking. When we went through this bout of financial instability, the market said, oh, you're going to keep easing, so the 2-year comes down. So you do this, right? Led by the 2-year time coming down. Now, we're still inverted, which is why we have a barbell position on. If we look at the end of the year, there's a high probability that we end up, the slope will be positive between 2s10s. It may not be heavily positive, but it's really going to depend on what the data looks like, if in fact they ease more than what we're forecasting for that shift in the curve. But remember, there's a lag between inversion and coming into the economy, because when you have this kind of high short-end rates, it impacts corporations and it impacts the consumer,
right,
which is a headwind to growth.
All right, so we've got about 30 seconds, Leslie. Really quickly, outside of high-quality bonds, what else are you recommending here?
Well, the majority of it's really been on that high quality side, particularly for us. But it's really the positioning. Let's talk about the positioning of the yield curve. So when we think about where we want to be positioned, you want to have that 5-year intermediate. You want to have that barbell on. We like investment-grade corporates and agency MBS.
Terrific. Leslie, always a pleasure. Thank you for coming by and explaining this sometimes complicated topic, but it's good for you to break it down for us. Leslie, thank you so much. Good to have you here.
Thank you.
And for more information on anything that Leslie and I spoke about, check out our Insights website at ubs.com/views. Plus, you can make sure to follow us on Instagram on our brand new relaunched UBS Trending Instagram channel. There's some great content up there, sound bites, promotional videos, and other information for you to peruse, so check that out. Plus, we're on all the other social media platforms as well. And if you do have any questions about your own portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon.